Hi, and welcome to the 2024 annual performance update from Forager Funds. I'm Steve Johnson, Chief Investment Officer here, and I'll be leading you through today's presentation. I've got about 10 minutes from me up front, and then we're going to get each of the teams in to talk about the respective fund performance, and then I'll wrap things up quickly at the end, and plenty of time for your questions too. So start thinking about some of the questions that you want answered. Before we kick things off, the usual disclaimer: this is general advice only. We cannot take your personal circumstances into account, and you should seek professional advice where necessary. It's been a busy but ultimately very successful year here at Forager. We've put you through your fair share of administration as well, so thank you for putting up with that. But with the delisting of the Australian fund completed in June and our international fund moving across to perpetual and atomic in January, we now have both funds on the one platform. So from here, your life should be a lot easier and ours should be a lot easier as well. It's the culmination of 5 years really of work into our business on the business side of things, importantly, but also on the investment side of things. We've been working really hard here to nut out exactly what we're trying to achieve for you and execute on that well. And I think this year has been a really good sign of that all coming to fruition. So I wanted to spend a bit of time at the start of today's presentation just summing all of that up for you. I know a lot of you have been investors with us for a very long period of time. I think it's worth rehashing where we've got to on investment philosophy and what our job is here in turn and the role that we can play in your portfolio. The bottom right-hand corner of this slide is obviously what we're here for. We're delivering or aiming to deliver long-term outperformance for you. But the ingredients for that are very important. Every funds management company says that's what they're trying to achieve. We think we've got some unique attributes. The top left-hand box there is you. We have truly long-term investors. And I want to take this opportunity to thank you for your support over the past 7 years in particular. It has not been easy all along the way, and I think the reward over the past couple of years of some good portfolio performance is much deserved for you, and we couldn't do what we do as fund managers without having that diverse group of investors and investors who are really willing to stick with us through the inevitable difficult times. Us being capacity conscious as a business is really important, and I've put in the right-hand side there contrarian behaviours. You've seen me talk a lot over the past 5 years about not being blindly contrarian for the sake of it, but being willing to be contrarian when the time is right is a fundamental piece of what we do as a business. And I think you've seen that in our best years typically, and that's what we are renowned for doing well, is taking advantage of those points of market turmoil and picking through those sectors that other people are finding very unpopular at any particular point in time. Those three ingredients really allow us to focus on smaller companies. It's where we think active management can add the most value to people's portfolios. It allows us to have very flexible portfolios. So we're not just sticking in one particular type of business or sector here. We're going where the opportunities are in the market. Now, I'll talk about risk management soon. It needs to be a very, very important overlay, but you should and will see our portfolios change quite substantially over time. And then once again, all of this ultimately needs to lead to long-term outperformance for you. The business today is 380 million or so of funds under management. It's 15 years since I started it. It really feels like it has flown by, that 15 years. But as I said in my letter to the annual performance report, I really do think this is an important junction for us. There were 7 years of really strong outperformance, particularly for our Australian fund in the early years here. There was a period here where I think we learnt a lot of lessons, and we've put those lessons into place in terms of the philosophy and the people that the business has today. And a couple of really good, more recent years of performance that I think set us up really well for the coming 15 years. We're still relatively young as a business. I'm still relatively young, although much older than I was in terms of my career. I think this next 15 years ahead for us can be a really good sweet spot of big enough to employ the right people, but small enough to still run adaptable, dynamic portfolios that get out there and invest in those less well-known stocks. I just wanted to touch on the team quickly as well. It has been a very, very strong focus of mine over the past 5 years. I cannot do this on my own. We've worked really hard to build up a team, and we've had stability here now for a number of years. We've got the key senior people across both teams that have been working alongside me for a long time now. It's more than 5 years in all of those cases. And again, you can see that in the way the teams are working together and in the portfolios that are coming together here. They're different types of ideas, different types of businesses, but being put together with a very consistent philosophy. We don't want or need a lot more than this. We've put a lot of effort into retaining the key people here very recently, even on this. And as a team, we just want to get on with delivering results over the next 15 years. I talked about really honing down what our investment approach is, and this is going to sound very simplistic, but I think it is important for me to reiterate it again here today. We aim to invest in businesses where we have a valid thesis for that business delivering above market returns over the long term. Now, that sounds simplistic, and it is what everyone else or a lot of other people are doing out there. There's also a lot of people just trying to predict where share prices are going to go in the short term. But we're not the only people thinking about this, but our objective here is really to buy a business where we're confident that business is going to give us excess returns over what you can get investing in an index fund or the wider market over a 5-year period. I've put a comment down the bottom there. We're aiming to put them in portfolios where we are mitigating the risks of any one assumption being wrong. And I said there that the thesis should be provable over a maximum of 5 years. Now, that surprises some people. We are long-term investors, but my experience has been if your thesis is not provable over a 5-year period, then it's not simple enough. And often we get the proof of the thesis here in 12 to 18 months even, that we had a differentiated view, we're collecting evidence, and usually that evidence comes reasonably early on that, okay, you're right here or you're wrong in terms of that thesis. And I think it needs to happen within a 5-year period. Otherwise, what you've really got is an unprovable thesis, because you're sitting there saying, well, I don't know whether I'm going to be right for 10 years. That's a very, very long time to have that amount of uncertainty. So the best theses, they actually prove up pretty quickly. That doesn't mean the share price moves. Some of these stocks will sit there and do nothing for years after we get evidence that our thesis has started to build, but we want to know that the business is delivering the results that we expected it to deliver. Now, this is probably the most important philosophical slide. As I said, a lot of people are trying to buy businesses that deliver them excess returns over long periods of time. Why a stock is cheap is probably more important, or at least as important as what it is. We're looking really for two different sources of excess return generation here. One is differentiated insights. We understand something about this business that we don't think is reflected in the market or other investors' view of it. Or often, the stock is being sold on emotional, irrational, or for emotional and irrational reasons, or the whole market is being sold for emotional and irrational reasons. And those two things can combine and be very, very powerful when you put the two of them together. And then this is perhaps the most significant evolution of us as a business over the past 5 years, is really taking that stock picking and turning it into a portfolio management skill set. We want to find cheap stocks. We want to invest in situations that other people are overly pessimistic about. Then we want to put them together in portfolios that mitigate the implications of us being wrong. Some really important risk principles in our portfolios. We're looking to add resilience to our portfolios. That often means a collection of businesses in the portfolio that we think are going to be more resilient to the economic cycle. Doesn't need to be the whole portfolio, but there is a place for that type of business. Liquidity is an increasingly important one for us. As we have grown, the advantages of being able to invest in stocks that trade more. It means A, we can get out of stocks where we've got something wrong. B, we can adjust our portfolio more rapidly. Again, there is a space in both portfolios for very, very illiquid stocks. We just need to recognize that there is a limit on how much of that we should have. And probably more importantly, there's a type of business that we want to invest in if we're going to take on that liquidity. And that is usually a business that's going to grow out of that illiquidity over time. And diversity, so a bunch of different sectors, different types of businesses, even different geographies that mean we're not completely tied to one economy, one sector, one type of business. And then portfolio constraints here, individual weighting limits for different types of businesses and different risks, limits on how much exposure we want to any one sector. Again, this is a concentrated portfolio. You should expect us to be having heavy concentration in our most attractive ideas, but we do want to balance that with how much risk we're taking on in the portfolio. And then the bottom of this slide is really important for people to understand. I've talked up the top here about the different types of businesses that we want to put together in a portfolio, and the different risk that we're taking on demands different levels of returns. So I said earlier, we want to outperform markets over time. The long-term return from equities has been 8 to 9% per annum. We obviously need to overcome our fees as well. So at the bottom end of this spectrum here, if we're investing in a large, liquid, fairly safe business, we want to earn a minimum of 12% over the long term. If we're going to take on risk, if we're going to take on illiquidity, if we're going to invest in a business with less of a track record, we want more return. And that can range from 15% per annum for a business where we have a better track record. We might have a good management team, good alignment, but it may be less liquid. It may be in a cyclical sector where we're going to have to deal with more variability, right up to 20% plus for businesses that are more illiquid, smaller, and riskier. And you will see this across both portfolios. We want to own a collection of different types of businesses along this spectrum, and we want to own businesses that themselves can move along the spectrum. So if we buy something that's at the right-hand side of that line, it's a 20% plus return. Where we make the Lollapalooza results is when it moves down towards the left-hand side of this over time. You'll hear about some stocks later in today's presentation where we really think that evolution is either underway or has happened, and where we've made a lot of money out of that migration down this slide. And as businesses de-risk, as the liquidity gets better, as their profitability improves over time, that also allows us to have higher weightings. And you will see this a lot in the portfolio, getting that initial weighting when the thesis is less certain, keeping it fairly small. You will see 2 and 3% weightings in our portfolios. As those theses play out, as these stocks move down this sliding scale here to become lower risk, lower required rates of return, you should see us, and you have seen us, really upweight some of those investments over time. All of that has translated into a really good year in 2024 on the back of a good year in 2023 as well. Both funds were pretty close to 20% returns for the year. You can see on the left-hand side there for the international fund, that's actually 4 good years out of the past 5. For our Aussie fund, it's 3 good years out of the past 4 now as well. And we think we are really well placed, as you're going to hear later in this presentation, to keep building on that performance record. It has been into some pretty strong headwinds in terms of small cap underperformance. The good news about that is that there are still lots of opportunities out there for us to invest in. The recovery over the past 2 years has now got the 5-year track record for both funds ahead of the index. As I just mentioned, this is for both funds an index that is dominated by large and mega cap stocks. The teams will show you some contrasting performance figures here for small cap stocks, but our benchmark for both funds is the wider indexes because we can invest in those larger stocks. So it's really pleasing here to see these 5-year returns back ahead of index for both funds here, and we're about to hear more from both teams on how that has been achieved. First up, we'll have Alex Shevelev to talk about the Australian Shares Fund. Hi, Alex, and thanks for joining us. Alex Shevelev joined Forager back in 2017. It's been 7 years with Forager now. He was promoted to portfolio manager of our Australian fund last year and has been doing a wonderful job running the portfolio. I've been joined over the past 12 months by Nicholas Plissas as an analyst over there as well, and teams working very well together. I'll hand over to you, Alex.
Thank you, Steve. We have had a very solid year of performance, nearly 19% on the Australian shares fund, which we're very pleased with. The All Ordinaries Index was about 6% behind that, and the Small Ordinaries behind again. If you look at the 3-year numbers on that slide, you'll see that it has been a period of quite substantial small and micro cap stock underperformance of the All Ordinaries Index. That's been reflected in our portfolio as well. But we are pleased to say that on the since inception number, continue to track above that on the All Ords side and meaningfully above that on the Small Ords side as well. Now going to some of the big contributors for the year. RPM Global contributed over 6% to portfolio performance. We'll touch a little bit on RPM later. It was part of a group of 10 stocks that contributed more than 1% in the year to portfolio performance, and only 4 on the other side of that contributed -1% or more than -1%. Now, the top 3, including RPM, they're actually some long-held software businesses. In fact, Gentrack was the largest contributor last year as well, over 5% positive contribution to portfolio performance. The next 2 there were acquired from our portfolio. That happened earlier in the year and gave us a nice boost into the 2024 year. And we had some offsetting negatives, including the prior year's second best contributor, THL, which again we'll touch on shortly. On to RPM. It's been a very strong contributor for the year. As a quick reminder, this is a software business for miners and mining services companies. It is growing a very valuable, high-quality revenue stream with very low churn. That means when their software is deployed into a customer, it very rarely gets switched off, and it is used in some very critical applications for those customers. We believe that over the next 3-odd years, we're going to see software growth of over 10% for the business. And very importantly, from this year onwards, we believe that there will be significant operating leverage as that cost base is put in place. New and incremental revenue will start falling down to profit at a much higher rate. We have here a management team that is very well incentivized as well. 3.6% of the company is owned by the CEO, and he's got a good history of running these businesses and subsequently selling them as well. Net cash balance sheet with a buyback in place. Early in July, we did see a slowing of that growth rate. It's a bit slower than we had hoped for, but it's pleasing to see that that continues to grow, and we think that operating leverage will start to kick in. Remains on about a 3% free cash flow yield to enterprise value, and we remain shareholders, although in a smaller way than you see at the end of 30 June. Gentrack's been another large contributor over the last couple of years. This is another software business. It's a provider for utilities and airports. A little bit about the background here. We came to this business when it was severely depressed in share price terms. The stock was down by 2/3. There'd been multiple downgrades, and it was just in the too hard basket for most investors. The market cap had gotten down to nearly 100 mil. Liquidity had almost completely dried up. But the business remained quite high quality in that core bit of recurring revenue. Again, very difficult to switch this product off once it is deployed in customers. There were some issues in the UK where those customers were actually going broke and therefore turning the software off. But we thought that the overall business was under earning with respect to the margins that they could generate, and Australia and New Zealand was faring somewhat better, as was the airports business. Now, when we bought this business, it was on about a 13% free cash flow yield 2 years out. That has now dwindled down, and we think largely this investment, for us at least, has run its course. So we've exited the vast majority of our position there. It has a lot more sell-side coverage, a lot more liquidity, and a lot more just general investor attention. Moving on to some of the lowlights as well. Big Tin Can was one of those. It is a software business, but in this case, it turned out the revenue stream was not as high quality or low churn as we had expected. Their customers are more able to leave them than other software businesses that we've discussed. And we also have here a board and management team that's failed to execute both operationally and with respect to capital allocation. THL was one of the top contributors last year. This year, though, some of the macro issues started to creep in to THL's results. They are a rental company, but also sell the camper vans that they rent into the secondary market after they are finished renting them. It is that element that was quite a large contributor in the last couple of years that this year, with fewer willing buyers of those camper vans, has shown a hit to the profitability of that business. Now, the rental stream, which is the higher quality portion of the business and why we own it, why we owned it originally and continue to own it, actually continues to grow. And we think that ramps up more meaningfully into 2026, such that the sales component will be a lower portion of the overall expected profitability. The top 10 stocks are displayed here. So RPM as at 30 June remains the largest position. That's since fallen down the rankings. It's no longer our largest position. One of the other larger stocks not to have contributed too much in either positive or negative direction is ReadyTech. We have higher hopes for that over the next couple of years. And in here, you can see 4 stocks that were not in the portfolio as at June 2023. It is a subset of new stocks for the portfolio overall, but you can see these new ones are making it into the top 10 with meaningful weightings and meaningful ability to influence returns in the 2025 financial year. They are Tyro, Camplify, Praemium, and NZX, and we'll touch on a few of those later on as well. The portfolio, as it stood on the 30 June, has a portfolio distribution that focuses around the 200 to 1 billion market cap space. Now, we see that as our sweet spot. We have continued large exposure on the information technology side. That's our software exposure. We also have financials and consumer discretionary. As you can see here, our tourism exposure largely sits in that consumer discretionary bucket. Moving on to some of those categories a little bit. Software, we've discussed a fair bit about the prior year's contributors on the software side. And in a short while, we'll talk about some of the prospective ones there as well. Catapult, ReadyTech, big positions there. On the financial side, about 20% of the portfolio, Tyro and NZX, good examples of the stocks we own there. On the tourism and leisure side, about 15% of a portfolio, including stocks like Experience Co, Camplify, and as we mentioned, THL. We continue to have mining services exposure of about 6%. That was a similar number to last year, but in that interim period, we've actually had Macmahon perform very strongly. It was, in fact, one of the top percentage performers during the FY24 year. And Parenti is another of our exposures there as well. We're not going to discuss too much this next bucket. We might leave that till later in the year, but we've been able to pick up some beaten up micro caps here that at the moment total about 4% of the portfolio. That's in addition to the larger stocks that you saw on the prior slides. There's a few of those that have sold off due to macro concerns, some liquidity-driven issues where there were big sellers and we were able to secure those positions at attractive forward returns. We're not disclosing them here because we think there might be bigger positions over time for the fund. On to 2025. So Catapult, now the largest position in the portfolio, had been a meaningful contributor last year, and we think is well placed to be a meaningful contributor in the 2025 financial year as well. They're a global leader in the provision of wearables technology to professional sports teams. They're little devices that go in vests that allow coaches to see how players are performing on the field. They've had a video division that has been a slower grower over time, but with an acquisition made a couple of years ago, with integration with their wearables business, that's become a bigger portion and a bigger driver of growth into the next couple of years. This is another business where we have a lot of recurring revenue and it is very, very sticky. So once a professional sports team starts using Catapult's technology, they very rarely switch it off. The churn is only about 4% a year. That said, the revenue growth is substantial as well. We're talking about over 15% revenue growth expected over the next 3 years. One of the things that had been lacking in the Catapult story a couple of years ago was that conversion of that growth into meaningful free cash flow. Management team has come through, they've integrated the product, spent the money to do that, and now are showing very strong signs that it will continue to be operating leverage driven, this business. So incremental revenue dropping down to free cash flow. Another to focus on is Tyro payments. Now, you would have seen Tyro's terminals around. They are the leading independent payment terminal provider. It's a big alternative for small and medium enterprises to the major banks. It is trading at the moment on about a 10% free cash flow yield, particularly attractive. It is facing into some macro headwinds, which has caused other investors to sell that stock down. And another interesting business in the financial space we've become recent investors in is the NZX. So this is the operator of the New Zealand Stock Exchange. It is also the provider of ETF and low-cost funds management in New Zealand, and also has a small wealth technology division that's akin to a Netwealth or Hub in Australia. There are quite a lot of revenue streams to this business. It's actually quite diversified, but one of the elements on the exchange side of things that caught our attention is the low velocity of the market turnover that they have seen recently. We think that is a cyclical thing, that we do get incremental revenue from more traded value in the New Zealand market. Associated with that, more capital raisings and more secondary and primary capital raisings, I should say, which will again drive their revenue. The cost base here is quite fixed, so that should see quite a significant amount of that incremental revenue come down to profit. The funds management business has been growing for quite some time and continues to do so. And on the wealth technology business, they've won some new clients recently. That's a business that NZX had spent more than $40 million on over the last 5 to 10 years. So it's been a cash sink. We think that business is close to becoming free cash flow neutral, and that will be a big boom for the amount of free cash flow that the whole business generates. Again, we think this business is over a 10% free cash flow yield to enterprise value when we look into the FY26 year. Steve, back to you.
Thanks, Alex. That's a really great summary of the portfolio here, and congratulations on another good year of performance there. Like I touched on earlier, it's 2 in a row. If you put 21 and 22 together, it's 4 years of good performance there, and I think really shows us continuing to build that performance record back up to where we and you want it to be. It's been in an environment of substantial small cap underperformance. You can see on this chart the cumulative impact of that over the past 4 years. There is stuff working, as you have seen, both in our portfolio and in the index as well. There are stocks that when they deliver good results are seeing that reflected in the share price. And it's actually quite an opportune environment for us. There's stocks working. We're able to recycle that capital into other stocks, like some of the ones that Alex just talked about, where the share prices have been hammered over the past 12 months and where there's a lot of value on offer. So really optimistic about the portfolio here and what we can deliver over the next 5 years from it. The fund was delisted from the stock exchange in June. You're probably very, very aware of that. Again, thank you for your input into that process, both feedback in terms of us doing it and then voting and then moving everything across to Atomic. I know it has taken a lot of administration, but this has been a pretty clear message. I don't think this just applies to us. I think across the wider listed fund space, you're going to see more and more of it. We wanted to do it early rather than be dragged kicking and screaming. And again, we've seen really, really good investor behavior here in our international fund over the past 5 years. We've got a loyal long-term investor base, and we're really just looking forward to getting on with life under the new structure here. We think we can grow the fund again. It's now daily unit pricing. I think it's a wonderful time for people to be thinking about their investment with us in this fund. You can get in and out at net asset value after this redemption fee period ends at the end of December this year. That distribution policy remains in place. We're targeting 4% of fund value paid semi-annually. For the coming year, that'll be 3.1 cents in January for the December half and another 3.1 cents in July 2025. And that gets reset to target 4% each year. And look, it's only a little piece here. As I said, the portfolio performance is far and away the most important, but because of the way past performance fees have unfolded, there's a fairly significant performance fee deficit here. The fund would need to outperform that 8% benchmark by 25% or more over the coming year before investors start seeing performance fees. So you can have a fund that's performing very well here with an attractive fee structure as well. With that, we will move on to the international fund, and I'll get Harvey and Gareth in to talk to us about what's been happening in global markets. We're joined now by Gareth Brown and Harvey Migotti, portfolio managers on our international shares fund. Gareth and Harvey have been working closely together here for the past 5 years on this fund and delivering some outstanding results. And they've got a couple of wonderful young analysts working alongside them at the moment, and I'll hand over to them to talk you through what's happened over the past 12 months.
Thanks, Steve. Look, just echoing what you just said there, continuity is the main theme here. This team's been together for more than 5 years now. We're very happy with the size of the team and the dynamic of the team. We think we could double assets under management without needing any additional staff. We've got the right team in place. Slide in front of you here shows our results going back to inception. I'd like to draw your attention to the 5-year result. Again, that lines up with the current team. Look, despite a tougher environment for smaller and mid-cap stocks over most of that period, we've outperformed the broader index, and we've significantly outperformed the smaller and mid-cap index. This past year has been good too, and really the message here is you don't need to own NVIDIA in order to outperform.
So looking at the portfolio contribution over the past year, as you can see, it was pretty broad-based. A lot of winners, diversified across market caps, across 10 markets, across types of companies, and only really one major detractor down at the bottom. If you look all the way at the bottom bar, you can also see that there's a really big tail of positive contributors there as well. So we're pretty happy with this performance so far, especially given our underexposure at this point to mega caps that drove a lot of the market returns over the past year. As mentioned, the breadth of contributors was pretty significant. High quality compounders is a large part of our portfolio, as you can see on the right-hand chart. Percent weighting of NAV. It always will be. We always look to find quality businesses that grow through all sorts of environments and try to buy them at the right price. That was our biggest contributor as a theme over the past year. Commodities and adjacents, while not a huge percent of our weighting, actually did very well for us. It involves things such as uranium or oil and gas exposed companies.
Small and mid-cap stocks is another area, evergreen category for us in this fund. We're going to talk later on in this presentation about what we think is a fairly unique opportunity set in smaller and mid-sized businesses. Where the rubber really hits the road is how do we turn that into individual stock ideas? How does that convert into ideas? And are they able to contribute meaningfully? We're going to highlight some of those individual stock stories over the rest of this presentation. And another area worth mentioning is what we're calling European yielders. This includes a few bank stocks in Europe that we've been able to buy on a yield to investors, annual yield to investors of about 15%. These stocks have been in the sin bin for more than 15 years now. We've bought them what we think is the bottom, and they have been one of the best performing sectors in Europe over the past 12 months. This category also includes an investment in Tesco, which is a boring but well-run supermarket business in the UK. Distributes a lot of cash to shareholders each year and adds meaningful resilience to this portfolio.
Yeah, so as mentioned, our quality compounder basket is always something that we like to fill replenish and add new positions to. Two examples of stocks that did well for us over the past year include CRH, which is one of the largest building materials companies in the US, focused on aggregates and cement. So if you think about new road construction and infrastructure build out that's happening over there, they are set to be winners. It's been a bit of an orphan stock and an interesting story. It was, most of its earnings come from the US, but it was listed in the UK for, most of its life, and in Ireland. Last year, they changed their primary domicile. They moved to the US, and that's created a bit of a discovery phase for US investors that tend to like these type of businesses. API Group is one that we've owned since 2020, long-standing stock. It's one of the largest positions in our portfolio still. Strong contributor for the second year in a row. One that we will keep owning until valuation gets crazy or something goes wrong.
I want to draw your attention to 3 small cap outperformers here. This is really bread and butter for this fund. Blanco is a technology business that we have owned for more than 7 years. Unfortunately, in our opinion, it got taken over late in 2023 at a price that we think was too cheap. Still, it has performed very admirably for us over a long period of time, and it is exactly the sort of business that we aim to own more of. Norbit is a Norwegian small cap technology related business. We bought via an IPO in 2019, a small position. We upsized that over time as we got to know the business. The more we got to know it, the more we liked it. This is a classic under promise, over deliver type management team, and have performed very well for us over the years. And lastly, I'll bring your attention to Motorpoint, which is a UK used car retailer. It had been one of our meaningful detractors over each of the past 2 years, and has been a meaningful positive contributor to the returns over the past year as the end markets have lined up and become more of a tailwind for this business. Commodities and commodity-related businesses has also been a meaningful contributor over the past financial year. Gulf Marine Services has been the biggest of those individual contributors. This is an oil and gas services business. We think it's still cheap, but it tripled over the past year and contributed meaningfully to results. The other thing I'd like to touch on here is our investment in Sprott Physical Uranium, which is an investment in the physical commodity of uranium. We've done really well out of that. The stock price nearly tripled over the first half of the financial year, and then fell significantly in the second half. I think it highlights some of the work we've done on portfolio allocation and portfolio management. We owned a lot more of this on the way up and a lot less of it on the way down, and we've done really well out of it without it ever being a huge part of the portfolio.
So looking at our current portfolio snapshot as of June 2024, on the left-hand side here, you can see that there are a number of new positions that we've added over the past 12 months, and that is because we constantly scour for new ideas and test them relative to our existing portfolio, trying to deploy the cash in the best way possible. On the right-hand side, similarly, you can see that 2/3 of our portfolio is in small and mid-cap type businesses. We always will have a majority of our portfolio in these kind of companies. We think that it's easier to unearth or get informational edge in smaller businesses than it is in some of the larger caps where you have 30 brokers covering them. On the next slide, what we'd really like to highlight here, on the left, you have a distribution by geography. It's broadly in line with what you'd see from a major index, but on the right-hand side is our portfolio distribution by sector. And as you may notice, it's pretty well diversified across various sectors, and we do try to keep a balance there, not being overexposed to one single theme, and trying to find interesting businesses across different sectors, which provides, I think, some resilience in volatile market environments in particular.
This slide shows some of the important themes of the current portfolio positioning. So a little earlier, we covered how the last year's results have come from various segments, and this is where the portfolio is today. As you would expect, underpriced small caps are a significant segment of this fund and always will be. We've touched on some of the important investments there that are still in the portfolio, like Gulf Marine Services, like Motorpoint, I would also include Payson in here, even though it's also a commodities business. And I'd just like to highlight one additional one, which we are not prepared to name yet. It's a stock that Harvey found in the US. It's a small cap business, and it has been growing very, very rapidly. We've invested a few months ago when the stock price has almost doubled. We're not willing to mention it yet because we think we might get another bite at the cherry. And as we've talked about earlier, quality compounders are an important part of this fund. They provide resilience, and they move to slightly different beats to some of the other segments in the portfolio. Harvey will outline the case for Clean Harbors later, which is a really important one. And we've also owned some big US housing related businesses, mainly on the distribution side, that have done really well. And they are still a small but important part of the portfolio. We are invested in commodities, as we've touched on already. Uranium is a smaller part now, but we own a lot of commodity services businesses and a few actual producers. And this concept of European yielders has also been important and remains an important part of the portfolio. We own a couple of banks. We own Tesco.
Moving on to Clean Harbors, which we've touched upon just now. We've owned this business for over 9 months now. Bought it towards the start of the fiscal year. Really like these kind of businesses. This is one of the biggest, as I mentioned, industrial waste companies in the US. This is an industry that's ripe with complex regulations, high customer switching costs, and, very high barriers to entry. For example, Clean Harbors has around 75% of the US incinerator capacity, which is a lot of their decent portion of their earnings. On the right-hand side, you can actually see the pricing power that they yield. Those bars that on the right show you that the average price increase has been generally between 5 and 15% over the past, 5 years. It's an amazing thing to see. And of course, as a customer, it's hard to go elsewhere when you need to burn your industrial waste. So they're winners from US reshoring, from US industrial manufacturing, from higher and more stringent regulations. Very long history of organic revenue growth, to bolt-on companies through M&A, smaller businesses. And, you add that together with pricing power, you have a pretty resilient business that we think has a lot more upside in the future. Seda Global, it's been a winner for us last year, and it was certainly a winner this year. Top contributor over the past, particularly 6 months. This is an ad tech business, which is essentially a one-stop shop platform for data-driven marketing solutions. They have a lot of proprietary data, which enables them in a cookieless world to identify users and help customers target people with ads more appropriately. I think it's a great example of a business that, when the IPO in 2021, it went sideways for a number of years, 2.5 to be precise, even though the company upgraded earnings every single quarter since they IPO'd. All of a sudden, the market decides to wake up. Stock doubled over the past 6 months. We still think it's attractively valued. The weighting has obviously gone down as we manage the portfolio more actively, but one that is an important part still. And we think if the management can continue to deliver, it should continue to do well over the coming years.
Payson Systems is a Canadian small cap stock, exactly the kind of thing we're looking for in this portfolio. It has a core business that provides services to the exploratory drill market, and it has a very significant market share. More than 65% of North American drill rigs utilize some form of Payson Systems service. What we like about this business is it's very resilient. They have significant pricing power. So despite rig counts in North America generally trending down over the last decade, Payson's revenue has marched upwards as more and more of the work of the drill bit is being outsourced to a company like Payson. One thing we did identify here is a segment called IWS. I won't go into any great detail, but it has been hidden by the vagaries of equity accounting. They have now acquired IWS fully. We think they can grow a business here that will be similar in size to Payson's core business over the next decade or so. We've acquired the whole package on 10 or 11 times earnings. It's gone up a fair bit since, but we still think it's cheap.
Thanks, Gareth. We want to leave you with this important message here, and that is that the setup for small and mid caps is really attractive at the moment. I mean, as you can see on the right-hand chart here, over a long time series and a long period, this is 25 years in this case, small and mid caps tend to outperform the broader, more stable parts of the index. They tend to do better from early on in a recessionary period. And in addition to that, they tend to be much under-researched relative to the large counterparts. So when you combine all those things together, and if you have a good process, you can find gems that help you, as Gareth mentioned, outperform even if you don't own the likes of NVIDIA. On the next slide here, we will show you exactly just how crazy the discount has gotten. If you look at the last 20 years, small caps have broadly traded in line or at a premium to the broader index. And all of a sudden, since 2021, you've had a huge derating. They're currently trading at a 30% discount. This has at least stabilized over the past 2 years, but certainly not been any sort of tailwind for us. And we can't promise you it's going to happen over the next 3 or 6 months, but it will happen at some point that this needs to converge back to normality. And we think this is a great setup to be exposed to the space. As mentioned, 2/3 of our portfolio is invested in these kind of companies. And we hope that provides to be an attractive tailwind over the coming years.
Thank you, gentlemen, and thanks for all of the hard work, and it's great to see the portfolio performing so well. Look, I just wanted to wrap things up here. This team came together 5 years ago. This fund has outperformed, as you can see on the slide here, 88% of Australian global small and mid-cap funds over the past 5 years. You can get it on Morningstar and look up that data if you want. In fact, it's outperformed most large cap funds as well, despite large cap funds doing very, very well over that period. I think the setup is really good for small cap stocks. You've got a team performing well and a valuation gap here that is going to close at some point in time, in my view. People often come to me and say, is now a great time to invest? Honestly, I don't know whether this valuation gap is going to close over the next 2 weeks or over the next 5 years, but the setup here is outstanding for 5 years of good portfolio performance coming from this small cap global part of your portfolio. We'll move on to Q&A now. You can see the panel there on your Zoom controls. Start punching in your questions, and we will just be a minute or so to get ourselves ready.